I'm sure you've seen tons of videos online saying things like, this ETF will make you rich, or you only need these 3 ETFs. ETFs are super popular right now, but here's the thing. Almost nobody talks about the mistakes most people make when investing in ETFs. These mistakes can quietly cost you a lot of money over the long term. In this video, we'll break down hidden fees, misleading performance charts, volatility, and even the real risks behind certain types of ETFs that are being recommended everywhere without proper explanation. So, if you want to invest wisely, avoid losing money, and actually make your ETFs work for you, stick around until the end. Welcome to Marduk Finance, where we explain investing concepts in a simple way. And a quick disclaimer, this is not financial advice. Mistake number 1 is assuming an ETF is well diversified without checking what's inside. Most people think ETFs are automatically diversified, and yes, for the most part, they are much more diversified than buying a single stock. But some ETFs are more diversified than others. The best way to check is by looking at the holdings in the ETF fact sheet. This tells you how many companies the ETF holds, what sectors they belong to, and how much of the ETF is concentrated in its top holdings. For example, the Healthcare Select Sector Fund, or XLV, holds about 65 companies. Most of these are large, established companies like Johnson & Johnson, Pfizer, or United Health. In fact, the top 10 holdings make up more than half of the entire ETF. On the other hand, the Vanguard Healthcare ETF, or VHT, is much bigger. It holds around 400 companies across large, mid-cap, and small-cap firms, and its top 10 holdings represent just 44% of the ETF. Because XLV is concentrated in large companies, it increases your risk if a few of those top holdings underperform, whereas VHT has broader exposure. Mistake number 2 is thinking ETFs are risk-free. Even broad ETFs, like those tracking the S&P 500, can lose a significant portion of their value during a market crash. For example, during the 2008 financial crisis, the S&P 500 lost around 50% of its value. Even in smaller downturns, 20 to 30% drops are common. Many investors see ETFs and think, oh, this is diversified, so it must be safe. I can't lose that much. That mindset can be incredibly dangerous. Sharp market drops can cause panic selling, locking in losses that could have been avoided by staying invested. ETFs are safer than individual stocks because they spread risk, but they still carry market risk. If you aren't prepared to weather market drops, safer assets like bonds or savings accounts are an option, though expected returns will be lower. Mistake number 3 is ignoring fees and commissions. Even though ETFs are generally low cost compared to mutual funds, there are 2 main types of fees to watch out for. First is the expense ratio. This is the annual fee the ETF charges to manage your money. Passive ETFs, which track an index, usually have very low fees. Actively managed ETFs, where managers pick stocks, tend to have higher fees, usually above 1%. Second, brokerage commissions or transaction costs. Depending on your platform, buying and selling ETFs may include trading fees. Over time, these costs can add up, so keep an eye on them. Mistake number 4 is ignoring tracking error. Tracking error is especially important for passive ETFs. If you're paying for an ETF to track the S&P 500, you expect it to match that index closely. However, it may not perfectly follow its benchmark, and that difference is called tracking error. A small tracking error isn't a huge issue, but a large one means you could earn less than the index you thought you were investing in. Tracking error can happen because of management fees, fund costs, delays in rebalancing holdings, or liquidity issues with some stocks. Always look for a lower tracking error, which means the ETF is following its index better. Mistake number 5 is focusing too much on past performance. It's easy to see a chart showing 20, 30, or even 50% returns and think, this ETF is a winner, I need to buy it now. But past performance does not guarantee future results. Markets change, and what was hot last year might underperform the next. Instead of chasing past returns, focus on the ETF's strategy, holdings, diversification, and fees. Make sure the investment aligns with your long-term goals rather than last year's performance chart. Mistake number 6 is trying to time the market or lacking a clear strategy. Many investors wait for the perfect moment to enter the market. The problem? Timing the market almost never works, even for professionals. Without a clear plan, you might buy impulsively after a big gain or panic and sell during drops. Time in the market beats timing the market. Missing just the 10 best days of the S&P 500 over the last 20 years could cut total returns by almost half. Instead, focus on a clear long-term strategy. Decide how much to invest, stick to it consistently, and consider methods like dollar-cost averaging. Finally, mistake number 7 is investing in leveraged ETFs without understanding the risks. Leveraged ETFs are designed to amplify the returns of an index, often 2 or 3 times. If the index goes up, the leveraged ETF goes up twice as much, but the leverage resets daily. Gains and losses compound differently each day, so on down days, the ETF loses more than it gains back on up days. Even if the index ends roughly flat, a 2 times leveraged ETF may end much lower. In my opinion, leveraged ETFs are not suitable for long-term investors, and certainly not for beginners. And there you have it, 7 ETF mistakes that could be silently eating your returns. If you found this useful, leave a comment, like, and subscribe for more investing tips. Thanks for watching, and I'll see you in the next one.